Welcome to JM Financial Mutual Fund's Fixed Income Outlook. In this short video, we would take a look at how different global and domestic factors behaved during the months gone by. This would be followed by our view on the domestic debt markets, which could in turn impact the positioning of our schemes. The 10-year benchmark U.S. Treasury yield decreased and closed at 4.50%, approximately 18 bps lower than previous month, whereas German and Japan benchmark 10-year yield increased by 8 bps and 19 bps respectively during the month. The Federal Open Market Committee minutes reiterated to the market that restrictive policy needs to be maintained for longer to facilitate the disinflation process. Several members showed possibility to raise rates if inflation does not show signs of durable cooling. However, the Fed, in our view, shall remain flexible in its approach if the labor markets deteriorates materially here onwards. Meanwhile, 10-year Japanese government bonds have risen above 1% for the first time in more than a decade. We remain watchful of the developments here as Japan is one of the largest holders of the United States Treasury, and the interplay between USD-JPY, 10-year Japan benchmark and US 10-year continues to provide uncertainty on global rates. Domestic 10-year benchmark yield decreased by 17 bps during the month in line with United States Treasury, 10-year of 18 bps in the corresponding period. The 10-year G-Sec traded in a narrow band of 7.15% and 6.98% and closed at 6.98% in May 2024, vis-à-vis 7.15% in April 2024. CPI inflation for April 2024 printed at 4.83%, marginally lower than the previous month's reading of 4.85% and broadly in line with the Bloomberg's median poll of 4.80%. Inflation declined to the lowest level since May 2023, largely led by decline in fuel and light index. Food and beverages inflation remained elevated at 7.87% in April 2024, marginally higher than 7.74% in March 2024. Core inflation stood at 3.23%, marginally lower than the previous month's reading of 3.24%. During May 2024, US dollar traded with a weakening bias and depreciated by approximately 1.6%, largely due to strength in constituent currencies, including Euro, GBP and JPY. JPY continues to remain under stress, despite BOJ moving away from negative interest rate regime, although during May 2024 JPY marginally appreciated by 0.3%. It is important to note the relative weakness of CNY, INR and IDR versus JPY. INR closed flat this month at rupees 83.47 per USD, however, traded in a range of rupees 83.10, 83.53 per USD. INR continued to remain relatively stable compared to other key emerging economies. Liquidity conditions remained tight during May 2024 due to restricted government spending amid Lok Sabha elections along with GST outflows. Average systemic liquidity remained in deficit in May 2024 at rupees 137,736 crore compared to an average surplus of rupees 20,240 crore in April 2024. In tandem with deficit liquidity, daily average of weighted average call rate, WACR, was higher at 6.61% compared to the previous month's average of 6.56%. In the coming months, as more inflows through government spending comes into the system, liquidity conditions could possibly ease. While economic indicators continue to show a mixed picture with no clear indication of the direction in which the economy is headed, current data points seem to be robust in terms of GDP, labor markets remain tight, and inflation, though moderating, seems to have stagnated at current levels, with potential upside risks. The intent of the Fed to achieve long-term inflation rate of 2.0% on a durable basis remains a valid hypothesis for now. With better than anticipated economic growth and tight labor market, the Federal Reserve gets additional time to carefully analyze the developments in the economy before deciding on the rate cuts trajectory. U.S. Federal Reserve does not seem to be in a rush to cut rates. However, in its recent policy, it indicated to reduce the pace of quantitative tightening. Beginning in June, the FOMC stated it will reduce the cap on Treasury securities it allows to mature and not be replaced to USD 25 billion from its current cap of up to USD 60 billion per month. As on 30th May 2024, the Fed's balance sheet size was USD 7.28 trillion, down from its high of USD 8.97 trillion as on 12th April 2022, however significantly higher than USD 4.15 trillion just prior to the quantitative easing in February 2020. Reasons for being cautious in India are: globally, rates remain elevated, resulting in slowdown in anticipated inflows on account of inclusion in global bond indices. While domestic inflation is susceptible to volatility due to food components, continuance of resilient domestic growth necessitates no rush for softening in interest rates. The risk of INR to have a depreciating bias basis, Public Bank of China (PBOC), may also allow devaluation of Chinese yuan renminbi to make its exports competitive compared to the JPY. The deposit credit gap in the banking system has sustained for a while, indicating that the shorter end of the curve may see higher supply due to the battle to raise deposits in the financial sector, thereby putting a floor for the overall curve. However, reasons capping the domestic yields are: the outlook revision by S&P may result in continuance of foreign investors' active flow, with 7 billion inflows into debt so far in 2024. Flows from offshore investors expected due to inclusion in the global bond indices from June 2024 onwards, which can result in a positive demand-supply equation. A record-high RBI surplus transfer to the government's coffers may result in reduction in overall borrowing in the budget, to be announced when the new government is formed. Fairly positive real rates, CPI for FY25 projected by RBI is 4.5% and repo rate is at 6.5%, maintained for a while.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.